for filing an incorrect audit report. So auditors obviously are not standing around and just waiting to be sued, right? Or they accept all lawsuits and say, oh gosh, got to pay this out. They're going to try to defend themselves in certain cases, and some of the different defenses that they could use against client suits would be a lack of duty to perform, which is why engagement letters are important. It's your contract. So they could say we didn't have a duty to perform that. Based on the contract, based on the engagement letter, we laid out what our responsibilities would be and what your responsibilities are, and we had no duty to perform that. Right? Another defense might be non-negligent performance. And basically the auditor is saying there is that we did our job in accordance with generally accepted auditing standards. We don't provide absolute assurance, we provide a reasonable assurance. And based on the work that we did and the evidence that we collected, we did our job in accordance with generally accepted auditing standards. So we were not negligent. We acted in good faith, and we exercised due diligence. And you could say, look, we were not aware of any. Because of that, we were not aware of any misstatements. Our work papers support our opinion. And that's, again, in these types of situations, this is why documenting your audit work, your evidence is so important, right? Because that has to serve the basis not only to support your opinion, but also as an auditor if you find yourself being sued by a client. Or you find yourself in situations where the government is coming in, the SEC, and looking at the audit work you performed on a client. The other thing that the auditor commits, contributory negligence, right? So the client contributed to it. It was negligent behavior on part of the client that's caused the loss. So the client, in other words, was responsible for the loss. If you had a system, so for example, the auditor might claim, you have a system of internal controls that were ineffective, right? And because they were ineffective, you were not able to detect, you didn't have a process in place to effectively to detect or prevent errors from occurring. So prevent a fraud from happening, right? The tone at the top was lax. You didn't have, you disregarded recommendations that we made, right? So the auditor can say, so because of that, you contributed to the loss. Or if the senior managers engaged in a fraud, you contributed to the loss. You have responsibility for the financial statements. And then finally, absence of causal connection. So the loss was caused by other factors, not the financial statements, not anything that the auditor did with respect to the financial